Hello, Face. Hi, Alexander, Hugo, Ren. Hello, Sinatra and Arena. How's everyone doing today? Okay, so here we are Wednesday. Let's start off with USD CAD right here. So I think we're getting to the point when you look at it, we're diverging right here on the 15-minute chart. And if this rally was real, we should start digging in our heels above 122. Okay, maybe 2150, but I think this may be enough of a pullback to begin scaling in. Good morning, Laura. And same scenario with the Dixie. I think we have to hold 9140, otherwise we're on our way back towards this 9080 level. So, just a little short-term pullback in the dollar here. Here's this 9140 level. It's looking corrective to me, and most of these highs in the dollar were confirmed. Okay. Euro Aussie breaking down, maybe, uh, I don't know. We have some lower numbers in equities off the morning, but this was a decent short. I've covered it. Yen is pushing up against these highs. We made new highs now, so we're not confirming up here either. When it comes down to the averages, we have this three drive now in NASDAQ. I was saying between 14.3, 14.5. We got to 14.3 last night. I started laying out bullish vertical spreads, option spreads in SQQ, which is a triple bearish triple Q. And here's the way it looks. Last long call was up in here, and I've been patient waiting for the numbers in NASDAQ. Doesn't mean I'll be right because I was patient. And yeah, maybe I should have bought it and rode it up there. But anyway, starting to do that with some December vertical bull spreads on here. Okay, so again, we're diverging on multiple time frames there. And the S&P, I think, just missed making a new high. Doesn't mean that it won't. So we'll see what happens there. And what else I want to really cover? Yeah, mainly this USD CAD, I think, was, this is a nice little pullback to try it. I know everyone wants to buy it down here that missed it after this day, but I think we're close to halfway back. Yeah, that was surprising, wasn't it? We got, we're talking about the end of the world for Bitcoin and put in a nice reversal candle. Not sure if that's going to set the low or it's another failing rally, but definitely cleaned out all the stops. So this market's too wild for me, man. And, earlier in the week, I was looking for some type of three drive in gold, and it's getting a little too stretched here. You see, I like it when they're tight. So, I don't know what to do with it. Normally for a three drive, you'll get, you know, first drive, then right around here would have headed back down for one more drive. So right now, gold and I don't know. Maybe we're going to rally back towards 1805 first. And silver was weaker than gold until today. It's trying to turn the corner. VIX is going to come in at 15. So we'll see if we can make a new low in VIX. And I think that's about all I have for right now. Oh, yeah, with the Canada. So Canada is not making new lows, right? And oil is going to make its final high, I declare, next high. So uh, doesn't have to rally much more to take out this peak. And then we had a gap in the aftermarkets, and it's trying to fight its way back. But you know, this would definitely help the long USD CAD cause if we made a marginal new high, or as far as I'm concerned, it doesn't have to. I would just like to see it sell off. So, Blake, how are you today? Today is Wednesday, correct? Yeah, Wednesday.
Good morning,
Oh,
Coach. How you doing?
okay, buddy. So, surprising reversal in crypto. Does it change a picture for you when you get a reversal like you had yesterday?
It does, at least near term, and that the move below 30,000. Like probably a lot of people, you see it and you go, okay, well, here it is. And sorry, I'm trying to expand the video here. I did something and it minimized everything. So, oh, here we go. Here, let me pull up the charts really quick. So when we saw that reversal yesterday below 30,000, and if you saw my tweet from earlier that session, we were right around, this, I want to say around the 32.5. And I was like, oh, it looks like it's going to roll over, it looks like we're going to try to break down. And it was somewhere around here.
Yeah.
And it did. It started to push below 30,000, but then buyer stepped in and we created a false breakdown. And so I was talking to Chris Weston yesterday of Pepperstone, actually last night, doing an event of theirs, and I was like, I wasn't short Bitcoin. I was hoping, and I still am. Most of you probably know this. I mean, I'm expecting a move to 20,000. I have been for a while, and I want to be a buyer somewhere down there. Obviously, I want to see where it goes once we get down there. But that's what I'm most interested in. So I was like, okay, here we go. We're going to start this little slide. And, when we came back above 30,000 and we came back above this previous low right there, I was like, okay, which was 31,000. I was like, okay, that's it. That's going to squeeze everybody. And it did. Now, your question, Dale, does it change the longer term picture? I don't know if it changes the longer term picture, but I think people that want to sell aren't going to really sell until they have like a confirmed, daily low below 30,000. Then they might, pull the plug. And that the same thing happened with Ethereum. Ethereum actually hit, the same lows basically.
You know what that reminded me of when it did that? I had John Netto on a few weeks ago. He's one of the guys that in the Unknown Market Wizards. He was very, very bullish Ethereum. He said, I don't care if it could go back and test that 1,800, 1,700 low. But you know what his year-end target is on it? You probably didn't hear the interview.
No, I didn't.
7,000.
Okay.
All right. So anyway, we're here again.
For what reason? Like I hear what people say, but how do you come up with a target like that? Is what arbitrary number? How do you pull an arbitrary number like that? Like why?
I don't know how he ended up with that type of target, but you just figure just a
RNG, random number generator. RNG.
I don't think Schwager would write about the guy if that's the way it was for him.
Well, I mean,
a random number.
I guess the question is like, how do you come up with a target like that when you don't know what do we know what the use case is for Ethereum or what projected? I mean, like, I gotta
Dale, in all honesty, let's put it in other terms, right?
Yeah.
Tell me a single market, whichever you want, that belongs to any type of instrument, right? Tell me a single market that if somebody told you that they believe that by the end of the year it's going to be fourfold, fivefold higher, and it wasn't some kind of a commodity that for example, the thesis was we're going to get like a horrible winter, and we have supply shortages that we already know about. So, for example, we expect the price of X to multiply. So tell me any other type of market that somebody would tell you something like this, and you wouldn't immediately be like, yeah, okay, sure.
Yeah. All right.
Yeah, I mean,
I'm just the messenger.
no, and I'm not,
and
I'm not and I'm not going to.
There's one way I could come up with it. Just looking at the range, call it 2,000 to 4,400, and you tack. If we ever broke out over 4,400, you could tack 2,500 on top of it arithmetically, and get 7,000. So anyway.
Yeah, I mean, I have 161% extension at 6,000.
Yeah, that'd be a pretty good call too.
And if he told me, hey, I think it's going to 6,000, I think this low is going to hold, and technically I see it going over here, and then I would go, oh, okay.
Okay, let's go with that one then.
Well, but he said something, so I don't, I don't know, and I mean, maybe he connects. I mean, because I have no other basis to judge a cryptocurrency other than
what. Hey guys, I don't even really understand what blockchain is. To me, blockchain is a bunch of blocks with letters on it connected with a chain.
I found it.
Steve? Huh?
There it is, Steve. That's your 7,000 target right there. If you connect the highs to.
Yeah.
Okay.
I'm going to argue his point for him because he's not
nice, Blake.
I'm just going to say that's probably what he was looking at, because again, to throw a number out here, unless I can see it technically, I can't. I'll say, well, why? Why?
Yeah.
I mean,
I don't blame you,
because it's like, I'm going to go back to 1999. And then you got a company that's like, I'm an internet company. I don't make any money, but my stock should be valued at X. And you're like, why? Do you have projected sales to reach that? We don't even know how we're going to make money, but our stock should be worth that. It's just because it's the belief system that it's going to go up there. Great. Okay. If that's your argument, that's your argument. Again, I'm just sitting here trying to figure it out. But I'm going to tell you this about Ethereum. So let's not argue.
Yeah, I didn't mean to sidetrack you for
let's not argue that point. But we had a bounce off the lows, and I have to say, Bitcoin and Ethereum, even though we've seen this little reversal, based on previous price action of what we see on cryptocurrencies, reactions from these lows, this reaction is very mild, and maybe we've got more to go, perhaps.
Yeah.
But I'll tell you right now, if I owned Ethereum and I owned Bitcoin, I'd be a little worried that, like, when I was looking at Ethereum yesterday, I'm like, okay, well, that little false breakdown, below 1,800, we're holding 1,900. I'm like, I bet I get up this morning and we're going to be trading around 2,300. That's what I thought this morning. And when I got up this morning and I saw we're still trading sub 2,000, I was like, well, that's kind of odd. It's still trading pretty heavy. And then I looked at Bitcoin. I was like, I didn't know why we weren't back at 35, 30. I thought we'd be back mid-range, at least. I still think that while we're below the 200-day moving average, you have to stay bearish. So any move above 40,000, I still think is a sell. But again, I look at the price action. I'm like, okay, well, I see they bounced a little bit, but man, they are still trading pretty heavy. So anyway, just some thoughts there. As far as my opinion on cryptos, because you asked, did it change my view of Bitcoin? And yesterday, when we went back above 31,000, I'm like, okay, that's gonna squeeze. But now that we're here, I don't know. I don't know. One of the things that I want to point out that it is right here. Let's look at Forex Analytics. Go over to the dollar yen basic technical analysis. Right here, the dollar yen pushing some resistance. We are challenging the the highs from late March, and the 127% extension last move lower comes in at 111.13. Very important resistance at 111. And then, we were trading at 111 and change. And then the dollar yen just really came under some pressure shortly thereafter. We were trading right around here, and then we just, slumped. A really quick 40 pip move lower. I'm trying to put my finger on the reason why, but it is trading heavy, and maybe the catalyst might have been the move lower that we saw in yields. Yields came under a little bit of pressure here. I still think yields are looking constructive for bulls, but we did kind of break down a little bit. So I think this move lower in yields might actually have a little bit of an effect on this yen, and I think that's what's moving the market at this moment. So just keep an eye on the dollar yen. I think the dollar yen is really important resistance up here. This could end up being a double top. I mean, especially if we trade back below 110.50. It's just something that I'm keeping a close eye on. I knew it was going to be big resistance up here at 111. I just didn't think that we'd have such a major reaction from those levels, so quickly this morning. And it's also interesting because you still have the S&P, which, I mean, you have volatility back near its lows. Volatility is back near its lows. The S&P's right at its highs again. The Nasdaq's at new all-time highs. It's like nothing's changed. Yeah, every time you think that the market's going to get a little bit of a blip, nothing's changed. So here we are again, right, Steve Stelios?
Groundhog Day, bro.
It is.
So don't forget your booties. Remember that from
Yeah.
the movie.
Yeah.
You
I
don't
remember that.
It's Groundhog Day, so don't forget your booties. That was the line. Come on, man. And the song, the song, they say love won't pay the rent. Come on, you remember that? No? Is it just me? Okay.
But,
I love that
all
movie.
Of a sudden, hey, Steve, sorry, Dale made a big call. He said crude's going to make a new high in reverse. That was his big call. And Dale, I agree with you. I think we're going to reach for the 74.76 level, 161% extension, and make a move. But anyway, I just saw crude coming under a little bit of pressure here as it hit new highs. So Steve Stelios, what's going on this morning?
Chad got me. He knows what I'm talking about. Punxsutawney Phil. Anyway, what's happening? You know what? You're talking about crypto. Yes, it's a very
Andy
impressive bounce.
McDowell, right?
Andy McDowell. Yeah.
Yeah, beautiful woman.
Very impressive bounce in the cryptos. And I wrote on the chat room this morning.
Hound.
I wrote on the chat room this morning. I said, look, if this was a false breakdown in Bitcoin, remember that flag on the daily, then I think we're either going to new all-time highs or 15K. I don't think there's anything in between for it. But anyway, enough about cryptos. What I'm looking at is actually the pound. We have tomorrow the Bank of England, and we got some PMIs today from Europe and the UK. Manufacturing PMI 64.2 in the UK. It's actually above 60 in Europe as well. This is all very constructive. Obviously, this is a big reaction following the whole COVID disaster. But I think for the Bank of England, there might be a risk that we will get something like the Fed or Bank of Canada who are tapering. I don't think they're going to taper, but I think we might get something hawkish out of them. And that's why I think we need to be looking at pound pairs. And if you guys remember, I've been talking about euro pound for quite a while above. Remember, Dale, I was looking at 92. 92 was the level to short. And I've been talking about 83 to 84, which is really the level to, if you want to be bullish euro pound, or if you want to be basically short the pound, that's, I think, is the pair to play. And we might get something from the Bank of England tomorrow that if we do get something hawkish, that is definitely going to push euro pound lower. And if we do get into that zone, then I think that's going to be a pretty nice risk reward long now. So counter trend.
Speaking of PMIs, since we got them in Europe, I forgot today we do have
that was a great
PMIs
call,
in the
Stella.
US.
We do, yes.
We have flash PMIs in the U.S. So how about if those numbers come in a little stronger than expected? What do you think happens here with the dollar?
Well, I think the way things are going, chances are they will come stronger than expected. What happens with the dollar? We're still in the aftermath of the Fed. It was only a week ago. So I think the dollar is probably, how should I say it? It's probably at risk of following through higher. So I think the market may be looking for reasons to buy the dollar. And if we do get a good number, I think the dollar is definitely going to keep going. And now, for how much longer, I don't know. Remember, my medium-term outlook for the dollar is not good. I think it was still going lower, but I've been saying for a while now. It's been suffering week after week after week. But we are due for a spike, and the market is now looking, or we could be looking for reasons to spike. And we got the Fed. If we get another, couple of good readings and things look like they might be at least temporarily doing better, I think the dollar is at risk of spiking higher.
Yeah, well, Steve, what are your thoughts here?
About which of all the things we talked?
Groundhog Day.
Oh, Groundhog Day. It's an amazing movie, actually. So I'm also treating this pullback in the dollar as a short-term pullback within the context of the corrective move higher. So I am expecting this corrective move higher to unfold even further. I would assume that there is not much more downside before that happens. I would put my line in the sand, I guess, at roughly 91. But 91.40 I consider to be a first significant area of support if we're talking about the DXY. And equivalently, I'm watching some of the rebounds in the instruments we've been looking for that have finally pulled back to be also temporary. For example, somebody mentioned copper. Yeah, somebody mentioned copper. Gold, silver. I do think that these rebounds are going to be short-lived. We're going to see another leg lower, and then we can resume the upside. So within that context, I find it rather hard to be constructive equities, although fully recognizing that the uptrends are in no way broken yet, right? There is no technical damage done to the longer-term uptrends. I just think it's a little bit dangerous trying to be long right now, right here.
Got it. Okay. Well, you look at the dollar, and it really coincides with what you're saying. There's a 38% retracement in the dollar index, so a little descending wedge here, which could end up being like more of a flag for the dollar index. Something that looks like this, if you will. Then the 38% retracement comes in at 91.44. So a lot of support down there. And if you're thinking, this is a constructive move and we might, reach a new trend high, but I think
I don't think it's a constructive move, but I do think it's the first leg of a more complex correction higher, to be exact.
Okay. All right. Well, very good. And so what do you think about this move that we saw in cryptos yesterday? Because Dale had asked if it changed my view on cryptocurrencies. So have you adjusted your price in cryptos higher, that now you're looking at Ethereum at going to 7,000? Is
typically speaking, I was looking for a lower low in both Bitcoin and Ethereum. Technically speaking, I was looking for a lower low. Okay. Typically, yesterday's price action satisfied lower lows in both accounts. At least the exchanges I'm watching, both Ethereum and Bitcoin had lower lows.
Yeah.
Having said that, I'm in very big doubt that we're done for all the reasons I mentioned yesterday. So despite this apparent kind of a false breakdown, being able to produce a short-lived rebound a little bit higher and hope.
You call that a hope candle.
Yeah, I still think that we're going to need to see a proper lower low before we find a bottom. So I would still be looking towards 24,000 after this rebound finishes in Bitcoin. I'm still going to be looking for levels closer to 1400 if we're talking about Ethereum. And of course, there are invalidation points, right? So for example, I don't want to see Ethereum above 2800 because that proves that that's not the case. I don't want to clearly see Bitcoin above 41,600, right? But as long as we trade below these levels, I still favor a proper lower low before higher.
Okay, yeah, I agree with you, and we did, as you pointed out, we did satisfy that we did make lower lows, although it might be a little false breakdown right here, and that if you're bearish, that is something you definitely should be paying attention to right now. So we have PMIs coming up later this morning, and if the PMIs obviously here, let me pull it up over here. The PMIs, we have Canadian retail sales coming out here shortly. The manufacturing PMIs, the market PMIs right here. Do you think it's going to matter? Do you think the market's looking at data now? Does it matter? I mean, personally, I think it does. I think that the market.
I think it does as well, Blake.
Okay, and so
especially given the, in my opinion, false optimism that the Fed might be turning more hawkish, I think that good data might be the catalyst for the next leg higher to begin in the dollar against the rest of the currencies. That's what I believe.
I agree, and I think I think data doesn't matter like it used to, but some pieces of data, anything that shows the pace of inflation or PMI, purchasing managers index and all that, I think that's important. Other data like employment, obviously always important, but I think people are looking at inflation very, very seriously now, and any kind of indication this is really picking up. I mean, it's already picked up. let's not kid ourselves, but any indication that it keeps going, I think is going to be met with more interest by the market.
So with that being said, one of the things that I think we should look at right now is take a look at what's happening in copper. Copper is correcting higher after breaking lower. And matter of fact, if I would argue that we're probably about this bounce that we're seeing, this little corrective bounce in copper might have run its course somewhere around here. But you can see lumber continues to stay really weak, and I'm surprised. I mean, we've seen a really big move lower in lumber prices, and I did expect a bounce last week. I think I mentioned that on one of our webinars. On my daily sentiment index is at 9. We're at the 200-day moving average. I expected a little bit of a bounce. We have seen a very marginal bounce, and it's trading heavy. It's that is surprising to me, that we're not seeing these commodities like lumber really recover here.
Don't try and catch a falling tree.
There we go. You might get splinters.
That's you. Yeah, all my old dad jokes. Yeah.
It's horrible as you once you become a dad for so many years.
I never even had a kid.
Blake, I think you're right. I think you're right about lumber, but you have to remember, yes, that was a big parabolic move. We have to remember we're almost 3 times higher than the usual. It used to be around 300, 350. The average. So we're still quite a bit higher. Obviously, that parabolic move was, it could never last. But if you look at the big picture, we're still quite a bit higher.
Well, we have Canadian data coming out in less than a minute. As you guys were talking about, the data doesn't really matter a whole lot. The data doesn't matter a whole lot, but maybe the Canadian data might move the needle a little bit, because the dollar Canadian had a hell of a run. I mean, this is a 120 to 125. It's a 500 pip move. We have retraced almost 50% of the move. We've reached the previous target of the double bottom target. We've reached that, so we should be supported around these levels. This should
It's weak numbers, by the way.
the Canadian data.
Yeah.
Did I just miss it? Oh shoot! Sorry. Okay, but it's not moving.
No impact.
No impact. Zero.
Yeah,
So far.
They're expecting -5% month on month, came in at -7.2. So
Let me see. Got it. Oh wow. Yeah. But you know, as you just pointed out, it's maybe the data the market's not focusing on right now. It's not inflationary data, right? It's not jobs, and has nothing to do with moving rates. It's consumer
Speaking
data.
about inflation data, I think that the funniest part of all is that following this Fed meeting, the market is now going to be taking strong inflation data as dollar bullish in the short term, which is so funny because it's the exact opposite of what fundamentally should be.
Yeah.
it's a new normal, dude. Get with the program.
Well, as DJ just pointed out, and he's very, very correct. It's the COVID hangover reaction. It's just consumers picking back up demand, and you're right. And that's all it is. And the market market's just looking past it because we already know it. Anyway, Dale, I know you have an interview.
Scottsdale resident.
Yes. So you guys.
Oh, there you go.
He's probably
Your neighbor.
Just enjoying this heat. It's miserable as can be. I'll tell you.
Yeah.
My pool filter went out yesterday, and it's like, dude,
Green?
seriously? After 30 years, my pool filter decides it wants to go out. So yeah, that's
This is first world problems, right?
huh?
First world problems.
Yeah, first world problems. That's correct. Yeah.
Wah.
It's just,
and also Blake Murphy's law. Of course, your pool filter is not going to come out during winter, right?
Yeah, of course.
And
I mean,
this is a new house, fairly new, Blake. So it wasn't the same filter. It was the one they had, right?
it's not my filter.
Yeah.
It's one that was put in originally when the pool was put in. But
I'd get back to the sellers.
yeah, it's like the fix-it guy was over, the pool guy was over, and he's like, yeah, your pool's going to turn green really quick if we don't get this handled.
With
I'm
this
like,
That's wonderful.
yeah, in this heat, exactly.
Yeah.
When it's
You don't want that black algae.
Right.
Yeah.
All right. So
All right. Well,
guys.
okay. Have a good day trading today, Blake and Steve and Stell.
Actually,
Best crew on the net. And Adam, Udem, welcome back to Face. I'm real interested in what's on your radar. I remember last time, Udem, we were talking, and to you, the long shot was maybe some upside in the dollar. So are you with us, buddy?
Yeah. Hey, are you able to hear me?
Yeah, now I can, Adam. How are you?
I'm doing good. How are you doing, Dale?
Doing fine, buddy. You want to share your screen here?
Yeah, I'm having a trouble getting this thing. Oh, here we go. Okay.
So yeah, I'm correct. I remember, your style of looking for, what is really contrarian and going out and buying a lot of time for, what could be an outsized move that no one's expecting. And I think it was you were looking at the dollar then for.
Yeah, I was looking at dollar and the yields. Actually got really lucky with that because right when the 10-year hit like 10.7, I loaded up on bonds just because I thought that it's like you were saying, the inflation data, first off, 2021 totally noisy, like base effects, everything, like the market, you see these headlines, it's like, oh, highest inflation data in 30 years and these scare headlines. But then when you go and actually look into it, it was basically all COVID sensitive areas. And that
so
could
you're
change.
In the camp that this is a transitory inflation event.
Oh, absolutely.
Like Powell.
Yeah. Well,
Okay.
unfortunately, yeah. Of just because I think even 1 or 2% inflation a year. When I say deflation, I'm talking like the sub 2%. And because over a decade that still adds up. You go to the grocery store and you still notice things are still getting expensive. But from, you know, a manufactured goods, like a real, you know, price of goods since the 1980s, since we entered the third industrial revolution, which was the infotech
Right.
and digital age. There's been progressive structural deflation, and it has been killing the Fed. Like the Fed. So to me, this, you know, I see a lot of people talk about inflation, like, oh, the, you know, the Fed, yeah, they're creating
successful.
asset bubbles and all sorts of problems. But the thing is that, so when people say, oh, you know, inflation started because we broke from the dollar, but, you know, to me, I mean, well, we had inflation before we broke from the dollar. That was the main reason we were breaking from the dollar. You know, the CPI rose like 60% in the 10 years before they broke from Bretton Woods.
You're talking about Bretton Woods?
Yeah,
Okay.
yeah. I mean, the CPI was, you know, it was averaging like over around 4 or 5% per year until they had a break from it. And then, you know, and then some people say, oh, that wasn't a real gold standard, which is true. But then you go back to the pre-war. The only reason that prices started, remember, the 1860s to the 1896 was the Great Deflation, and the only thing
that was
got
the longest depression in U.S. history.
Yep,
after
it was
the
literally
Civil War.
Yeah, I think there's a.
And we have another Civil War going on now.
Yeah, that's true.
In a way. Okay.
And
all right.
When you look, I wonder if I could find that chart. I saw a beautiful chart.
So does this mean that the break that we had in inflation hedges or hedges against, you know, a weaker dollar like gold and silver really took it on the chin last week with the Fed just jawboning? They didn't do anything and they took $100 out of gold.
Yeah, see, the thing so I view gold as a deflation hedge, not an inflation hedge, because like I was saying, when the Fed is when the Fed is okay, so since the 1970s, when we entered the third industrial revolution, we were basically, all the effects from the second industrial revolution were wearing off, and the second industrial revolution touched every aspect of the world and the U.S. You know, the networking from homes, clothing, women, you know, mass supermarkets, the Eisenhower building the 41,000 miles of interstate highway. I mean, the labor, the demand for all these things was so much. I mean, if you look at the daily life and the quality of living between the average American between today and the 1950s, it's not much different. Like, you know, the car pretty much, there's been marginal gains in vehicles since the 1950s. There's been, you know, same with air. We hit peak air service and quality in the 1970s. But if you look at the like from 1870 to 1940, these were huge changes. So the thesis that I'm going off of is that since the third industrial revolution started post 1970, it's only really been revolutionary in information, comms, and entertainment. Besides that, it's been very slow progress. And unfortunately, the marginal productivity from it hasn't kept up. If you look at total factor productivity since the 1970s, it's been in like a secular decline after, you know, like a brief uptick in the 90s because of the dot-com, you know, the gains from the dot-com, everything soaking in. But so the Fed at this point is stuck with their foot on the gas trying to fight this structural deflation. That's what's causing these asset bubbles, and has created a wave of unintended consequences like wealth inequality, asset bubbles, you know,
housing
inflation,
shortages.
Exact housing shortages. And the more they trying to get into each sector, try to fix it, they're making it worse. Like LBJ started his Great Society, which Nixon picked off as his Abundant Society, and JFK before him had his New Frontier. All these were like bigger government. You know, we can do guns and butter. And they ended up finding out that butter was a hell of a lot more expensive than guns. And today we're stuck in this entitlement riddled economy. And so my thesis is there's a backdrop of deflation from the structural side, which the Fed is trying to fight. But by them fighting it, not even just the Fed, look at Japan, Euro, you know, all of them are trying to fight this structural deflation. And they've printed waves of money, and it's just not, it's
Yeah, your headline
not-
on your website. So what are the market implications of your thesis and your narrative?
so
You have a lot of people leaning the wrong way because of this, or are bull markets and equities which continue to this day with NASDAQ making new highs? Are they
yeah,
wrong-footed? Are they
no,
wrong-footed?
I think we're gonna see higher asset bubbles just because that money, like higher order goods, like whoever gets that money, the cancel-on effect. The first people who have access to that money are the financial Wall Street. The problem
Right,
today,
banks.
like literally the reverse repo since the 80s, there's been a savings glut. The problem isn't credit. Clearly, it's at this point, it's demand, it's attractive investments. And things were a little bit better after the 90s, like up to 2000s, because China finally stepped in, and China was the big, China was going through their entering their third industrial revolution, but they went through it extremely rapidly, and all those apartments and all those highways and malls and this huge transfer of the, like America, when the rural, we had the huge, in the 1870s, 75% of the US population was rural. Now it's 80% urban, 20% rural. You can only have that move once, and
Well, there
China's,
is a movement back to rural out of the cities, but it probably is a small compared to what you're talking about.
oh yeah, that big influx into the cities is
Yeah.
same with China. They had to build all the infrastructure for it.
They have a lot of ghost cities.
Yeah, the ghost cities. And the thing is, I was looking at the incremental output, dollar output for what's that measure? It's like, I just posted on my Twitter recently, but
Of QE, well, the bang for the buck they get on.
China, basically they're at like 3 to 4 historically. They just hit over 10. So for every $10 they're investing on infrastructure, they're getting $1 return. So clear, and
weak.
Yeah, China's infrastructure boom is over. And the whole theory was, after 2008, all of the analysts were saying it. Oh, well, Peter Schiff even was saying it. Like, all these guys were like, well, China, they're going to consume what they're producing.
Yeah,
And it's going to be a huge move. But they're not. Yeah. They're running huge surpluses. So clearly, if you're running a surplus, it's deflationary because you're putting out more than you're consuming. In Germany, the Eurozone is the biggest surplus nation in the world. But the thing is, Germany and the Euro, they're also running QE while running surpluses. So that means Japan, same thing. So to put that in perspective to some people who don't might not know what that means, when the Eurozone's running surpluses, they're not issuing debt. So they're not putting out a lot of new bonds. So when the central banks, like the ECB, are buying their bond program, like their QEs, they're soaking up whatever bonds are left. So that's why you've seen a huge transfer since 2015-16 of Eurozone investors buying US bonds, like huge amounts of bonds, because there's no Euro bonds. The QE's absorbing whatever else they can get. And I mean, no wonder the yields are negative. I mean, there's no, same with Japan, like there's no coincidence. So you have the US now as the marginal deficit running nation. And, a lot of people said, oh, China's going to, take the place and consume all this stuff in the world. And China's clearly not done that. Their consumption to GDP, it's at like it's the lowest of any developed market. And China.
Okay. Yeah. So you're talking about bond defaults in China, and they've been, they have been tapering, right?
Yeah, they have. So
they've been tightening. They have been tightening.
Yeah, okay. Look at this thing. Final consumption as a share of GDP. China's is, it's back to where it was in 2005. It's barely 55%. And America's
so the handoff
like
from an export economy to a consumer economy is fumbled. They fumbled the ball on the handoff.
Yeah, and the thing is, there's a guy, Alex Gerschenkron, and he came up with the Gerschenkron growth model, and the Soviet Union followed it. It's called economic backwardation. Soviet Union did it. Japan did it. Some of the Scandinavian countries did it. China did it. And South Korea basically did. Basically, the idea was the government will come in, ramp up infrastructure spending, make a really nice export industry. Then you'll use the money from exports to build up your own domestic industry. But the problem is eventually, like Soviet Union or Japan, you get to a point of diminishing returns, and you're supposed to do that handoff. But the people who come into power and the wealthy who made money off of exports, they don't want to just hand it over to consumers. So they keep, lobbying and getting, the wealthy get wealthier, and the export supply side in those countries end up, basically holding power until there's a huge crash. And that's what Michael Pettis, who wrote one of my favorite books, Trade Wars or Class Wars, last year. It's a great book, highly recommend it. He basically says that China's in that position right now. And he said they could go about two ways. They can rebalance their economy from the supply side to the demand side, so they can stop repressing consumers and artificially boosting infrastructure and exports. Because to have savings to fund the infrastructure, they're forcing consumption to stay low in China. That's how they've been able to afford all these infrastructure. Same with Germany, same thing. There's big surpluses. They have to basically force their consumers not to demand as much. America's the opposite. So, but here's the kicker: China doesn't want to. The elites in China don't want to give up their power, and China's trying to do it now. They're trying to rebalance safely, but like Michael Pettis brought up, no nation in history has been able to rebalance willfully. It always comes down to basically a huge crash happening, and then there's a change of power. So who knows? Will China be the first country to rebalance, from the supply side to the demand side peacefully, like you just said, with the handoff? So far, it doesn't look like that, and China's trying. The elites are trying. They're telling people hey, we're not going to bail out certain, bonds or industries. But the thing is that true? Who knows? Usually China has a hidden contract with their people, and it's been, hey, we'll make everything smooth with you as long as you tolerate our communism and our, government control. But if unemployment goes up, and that's the real thing right now, is so China's putting out huge amounts of surpluses, like excess goods, and it's basically forcing America to absorb all this marginal supply from Germany, the Eurozone running huge surpluses, Japan, South Korea, China. They're basically depending on America's deficits to fund these demand. And they'll happily buy the dollars because there's, the dollar's a safe haven. To them, you need the dollar. And China doesn't, in my opinion, doesn't want a reserve currency, because if they have a reserve currency, they're gonna have to run huge deficits. They don't want it now, at least.
All right, since you're focused on China, isn't food security an issue there now? If you look at what's happened to, you could say there's no inflation, but there are exceptionally high prices for grains and meats. And, I looked at some live cattle and live hog prices, and I used to run on the floor of the CME, and the prices just completely blew me away to where live cattle's trading. And we all know beans went to, $15 and corn $7. Isn't that really the biggest problem? It always historically has been food security in China.
Yeah, that's true. And right now we're seeing,
They have
China
that
had their
clean
entire
plate.
pork supply slaughtered in
right.
2019, and they've had to rebalance. And here's another kicker, grain prices.
So would you
soared
be
in
short
wheat.
China, the FXI or something like that, Adem?
Yeah, basically that's what I'm, long dollar, long bonds. I think that the inflation was transitory. Another thing, in short China, another thing is, I like this thing. If you look at this chart, total fertility rate in the United States, basically the
Wow.
only period where we ever really had a huge stagflation, inflationary period, was the only period where we had lag effects from a rising fertility rate.
That was after the
And we're
war.
back down. Yeah.
That was
after
a
World War-
baby
World War
boomer,
II.
right?
Baby boomer. Yep. Baby boomer. And then, it petered out. And right now we're back. We're at its all-time low almost.
Yeah. So how come there are people saying that it's, the millennials are a bigger generation than yuppies? I sure don't see it on that chart. And
Yeah,
You
no.
know, they're kind of saying that they're behind the housing boom, and you know, that you know they're in the family formation stage, and so what do you think? I mean, there's a shortage. Do you believe there is a shortage of housing here?
Oh, absolutely. And that's all the government. I mean, literally the two sectors. No, I'm sorry, the three sectors: education, healthcare, and housing. The government stuck their grubby fingers in, and they've made the supply side worse with regulations, and the costs have soared astronomically, basically from, no doubt from the asset price inflation from the Fed. But I basically you've created artificial demand from the Fed side, and then you've limited the supply from the governmental side. Like I just see people say, oh, we need more government. And it's like, look at the three sectors with more government, we're spending insane amount of money on, and it's broken, and it's worse than ever. And it's just like, it's mind boggling to me where I see some more people say we need more government, and more intervention. And I mean, that's not going to fix the problem.
Yeah.
Yeah, I don't know.
Okay.
I mean, yeah, I think, I
So
think
we'll all be living in tents if you don't have a home by now.
yeah, I mean, we're
So
even seeing yield-starved investors with all that, the
yeah,
savings glut happening. Your yield-starved investors they have two options at this point. It's like buy U.S. Treasuries because there's nothing else as attractive at that yield. I mean, they're not
or
going to go risk it
stocks.
other places. Yeah, or stocks. And even a lot of them are hesitant with stocks because the Europe was a prime example of this. Negative rates were supposed to push money into the markets. And the Euro investors were like, you know what? I'd rather lose 0.5% a year from negative interest
Yeah.
than going into the market and the volatility tax. It drops 50%. Then I have to recoup 100% just to get to break even.
You don't do you think that we're, you know, with what's going on right now, that the markets after this parabolic run, and they have been parabolic if you look
Oh,
at the
yeah.
logarithms,
Oh,
are
it's
due
insane.
for that? Do you think we'll get that 30 to 50% tax you're talking about on drawdowns
I think
next year?
eventually, yeah. I mean, I don't know if it'll be next year. I mean, it'll be some black swan
How
event,
about this
but
summer?
I really, I don't, I have no idea. Like,
Okay,
honestly,
that's
I
fine.
have,
That's a
yeah,
that's a great answer.
I am the
Uh,
worst market timer, so I
all
don't even
right,
ever
so with
bother.
all right, so with all this you know, massive liquidity in US households, what are they going to do? Spend it at Costco
Yeah, I mean, I don't,
on vacations, or
the
you
thing,
know,
I
some
think,
maybe they like having savings and they don't spend it.
yeah, and that's what we're seeing today, which is technically against Fed theory. And I'm sure it's driving the Fed insane. And I think so compared to the taper tantrum in 2013, the yield curve has actually started flattening um, instead of steepening, even with the Fed talking about hiking. And I think it's because the bond markets at this point, they're like the fiscal impulse from the stimulus is wearing out at this point.
Yeah,
And it was front loaded, the stimulus checks, it was front loaded.
yeah,
And by 2022, 2023, even if they do raise rates by then, they're probably going to be tightening into a recession at that point. I mean, the same exact thing as 2018. It's like once that stimulus wears off, you're going to start talking about tightening, pulling out, like they're overcompensating with QE at this point. Clearly, I mean, the repo market shows it. I mean, it's probably going to go over $1 trillion, in my opinion, just because there's such a glut of savings and an imbalance as the Fed is emptying their treasury account. I'm sorry, the treasury is emptying their TGA account. So you're having an imbalance of bonds,
yeah,
a collateral shortage at the same time where banks are loaded with credit. So yeah, like again, like you and I were saying, credit isn't the problem. It's attractive investments, and the Fed can't fix that. Like what I mean, the government can, but I was reading these studies. This isn't like the economy of the 1940s, like going and repaving roads. I mean, you could do it to create jobs, but the roads are already built. Like that, Amazon driving to my house to bring whatever goods, them
yeah.
repaving the road or fixing up a bridge, it's not like that's going to bring huge returns to Amazon. I mean, they're still going to get here probably at the same time. Maybe they won't hit a pothole every now. It's not like they're blowing their tires out every time they drive down my road. So, I mean, the government could do it just, to create demand, but
Like ghost cities, there'll be ghost roads.
exactly. But like we're seeing in China, it just doesn't work. I don't know. It's not realistic to think that they're going to just keep repaving roads over and over again. Not to mention the amount of workers today
Yeah.
that would benefit from it is way smaller than the 1940s, 50s economy.
So I mean, especially the demographic argument you showed with that chart. So say, for example, theoretically, and I'm not holding it to you, and I come to you and I go, Adem, you know, I have $100,000 worth of risk capital. You know, I realize I can lose it. That's why I call it risk capital. How would you deploy it?
Well, I would,
And if you and cash is you know, a position.
I
Would
would,
you
yeah, I would
stay?
do cash. I
Yeah.
would do, I mean, I loaded up on gold in 2017 and I haven't sold it and I don't plan to because the more deflation there is, the more the Fed prints, which is going to
Yeah.
drive it higher.
Okay.
Gold at today's, I don't know. I mean, it's relative, obviously, but I guess if you don't have any, I'd get some.
Okay.
And I like nickel. I think nickel has good supply side fundamentals.
Okay.
I think uranium's good. I think uranium got really hot.
Yeah.
That was like one of my best trades last year, but it's really, there was
Cool
a
down.
ton of capital. Yeah, I think there needs to be more of a cool down in
So have
uranium.
the uranium shares pulled back at all? Or are they still
Hardly.
marching?
They're still
Hardly.
pretty, I mean, CCJ
So
is up
that's why
significantly.
we need like a 30% tax on the market so that these assets that you like could get cheap one more time.
Yeah, exactly.
So I mean, that's
would,
what I'm rooting for. You know, like 30% decline, and because you could own the best stock in a bad market, it doesn't matter. And therefore,
exactly.
all the things you just mentioned, nickel, uranium, all these things will get thrown out with the bathwater if we have one of those events
Yeah.
this summer. So
Yeah, and that's the thing that sucks about those. The volatility tax, like Mark Spitznagel, the guy who runs Universa, the tail hedging fund. I mean,
yeah,
it's the volatility tax. That's what kills compounded annual growth rate returns. It's not like a stock underperforming 2% a year. It's you making 5% a year for 5 years, and a 2008 happened and it wipes out 50% of your capital. Then you have to literally mathematically make 100%, not even including opportunity cost at that point, just to get back to break even. So
yeah, Laura backs up your point. She lives in Argentina. And she said every sector, absolutely each one the government gets their hands on gets destroyed. Education, health companies, airlines.
I mean, there's more than enough empirical evidence at this point to show that the government can't manage it, because like what happened in the Soviet Union, they had great oil assets, but they had to use the oil assets. When you're an oil company, you have to reinvest in oil, for example. Soviet Union's biggest export was oil and grains. They were taking all the profits from those areas to buy their military, and then when their oil wells broke down and their fields weren't there, people were dying of starvation, right, under Stalin, but they were exporting record amount of grains to Germany. Like, to me, it's just crazy.
Hey, let me ask you, Adem, on your fertility chart there, the rate, and when we had that bounce, where did that peak? 1970 or 1960? It
peaked in 1960.
Okay, it wasn't me.
Oh, were you after that?
Well, I was too young to add to the fertility rate. Anyway, so it was a joke too.
Oh,
so anyway, don't blame me for that pop, guys. Anyway, Adem, best way for people to follow your great work.
Oh, I appreciate you having me on, Dale.
Yeah.
Best way. Oh, yeah. My website, Speculators Anonymous, or just Twitter at Radical Adam.
Okay, and keep an eye on China. They're at a crossroads here.
Yeah.
Okay.
Agree.
All right. Great interview again, Adem. I appreciate you being with us, my trading warrior brother. Good luck on the long dollar positions. I'm with you for a while. So
great. Thanks, sir, and hope to speak again.
We will.
Absolutely.
You're a regular, buddy. You made it.
Oh, I appreciate it. Definitely. Thank you.
All right, buddy.
All right. Take it easy, guys.
All right. So everyone, we'll see you tomorrow. You could join the team for the morning edge, and you could shave and go in there for the morning edge and hang out with the team, see the bias chart, and ask Blake questions, and Steve and Stell and the whole team will be there for you. So have a great trading day. Tomorrow we have Ben Maldonado with us. Should be another excellent interview. Thank you for your attention, everyone. You're very welcome. Adios.